Did you know that right now, someone is out there frantically checking the Bitcoin balance, hoping it's worth enough to buy a house today, or at least a pizza? The same pizza that once cost 10,000 Bitcoin in 2010 is now worth about $600 million. We use money every day without thinking much about it. Whether it's a physical cash in our wallets or the digital dollars on our cards, it all feels familiar and works pretty well. But then there's this thing called cryptocurrency, or crypto. It promises to be the biggest revolution since the internet. Bitcoin is digital, but how is it different from the digital dollars already in your bank account? And why do some people treat it more like digital gold rather than digital cash? In this video, we'll compare traditional money and crypto, explore their key differences, and tackle the big question: is crypto truly the future currency? Or is it just another financial fever dream? Let's get started before the price changes again. First, what exactly do we mean by traditional money? Economists call it fiat currency. It's the official money issued by a government or central bank, like the US dollar, the euro, or my own, the Aussie dollar. It sounds fancy. I suppose it means it's money because we all collectively agreed not to question it too much. And honestly, when I think of money, a money printer comes to mind. The sound it makes is a soothing lullaby for investment bankers everywhere. Traditional money exists in two main forms. Firstly, it can be physical, for example the coins and banknotes you hold. And secondly, it can be digital, such as the electronic transactions and records stored by banks. There are several key features that define it. Control is centralized. Governments and central banks issue it, control how much of it exists, and regulates its use. For some reason, a money printer comes to mind again. Don't know why. It's also legal tender, which basically means the government declares it as the official way to pay for things, and so it is. It has trust-based value. Its value comes from our collective trust in the government and in the money itself. And finally, it's relatively stable. While inflation exists, its daily value doesn't swing wildly compared to most assets. So whether it's physical or digital, traditional money operates within a centrally controlled system. Crypto is designed to be different. How? Let's find out together. Let's use Bitcoin as a crypto example, since it's the most valuable and recognizable. Bitcoin was created by someone called Satoshi Nakamoto, who could be anyone from an alien to a time traveler to someone who's exceptionally good at hide and seek. Bitcoin is digital only. There are no physical Bitcoins to hold. Like digital cash, its value transfers online, but that's where the similarities mostly end. Bitcoin was designed to operate outside the traditional system in several important ways. It uses blockchain technology. Think of blockchain as a global spreadsheet that everyone can see, but no one can tamper with. Transactions are verified by network participants called miners and are recorded on this public, distributed ledger. It's decentralized. There's no central authority, no bank, no government controlling it. It's all peer-to-peer, which means there's no boss and no one to call when you forget your password. It also has limited supply. While central banks can print unlimited money, Bitcoin has a hard cap coded into its DNA. Only 21 million will ever exist. No new magical Bitcoins popping up here. Its source of value is different. Bitcoin isn't backed by any government. Its value comes from its scarcity, network security, user adoption, trust in the technology, and market demand. So while both traditional currency and Bitcoin can be digital, almost everything about how they work is fundamentally different. So is Bitcoin just another digital payment system then? No, not quite. Thinking of Bitcoin as just digital money misses what makes it revolutionary. Firstly, it's a potential store of value. Due to its fixed supply, many compare Bitcoin to digital gold, an asset that might hold or increase its value in the long term. While cash typically loses purchasing power over time due to inflation, Bitcoin is seen by many as a hedge against inflation. Of course, it can also lose 20% of its value while you're standing in line at Starbucks, but hey, no investment's perfect. Second, it's censorship resistant. Traditional digital payments can be blocked or frozen by banks or governments, but Bitcoin's decentralization makes it extremely difficult for anyone to block transactions. Third, it's a completely different system. Digital traditional currency is just an electronic version of the existing centralized banking system. Bitcoin represents an entirely new alternative system that validates transactions through its network. No bank is necessary. Finally, crypto can be programmable. While Bitcoin is somewhat limited here, other cryptos like Ethereum enable smart contracts, which are self-executing agreements that don't need middlemen. For example, crop insurance could automatically pay farmers during a drought without having to wait for an insurance company to process a claim. Traditional money excels at one thing: enabling the exchange of goods and services. It's also widely accepted, relatively stable, and easy to use for buying things. Using Bitcoin as everyday money faces several significant challenges. The first one is volatility. Its price can swing dramatically. 10 to 20% daily movements, which happen from time to time, can be terrifying. This is why crypto enthusiasts invented the term HODL, which stands for Hold On for Dear Life. The term actually comes from a drunk forum user who couldn't spell hold correctly. I think it's a pretty fitting origin story for crypto actually. Secondly, there are the transaction fees. The network charges fees that aren't fixed and can be quite high during busy periods. And finally, there is limited acceptance. Despite growing adoption, far few places accept Bitcoin directly compared to cash or cards. Because of these issues, many view Bitcoin less as digital cash and more as a store of value or a speculative investment. Hodlers often hope its value grows due to scarcity and increasing adoption. Since its beginning, Bitcoin's value has been increasing, but it's still been a bit of a roller coaster. Because of this, its store of value status is hotly debated. I mean, an asset that can move 20% in a day isn't traditionally considered stable. Most other cryptos are even more volatile than Bitcoin. So, who wants to use crypto if you can't rely on its value? The crypto world has tried to solve this volatility problem with something called stablecoins. So stablecoins are cryptos that are pegged to assets like the US dollar. They attempt to combine blockchain benefits with price stability. Popular examples of stablecoins include Tether, USDT, and USD Coin, USDC. They aim to always equal $1 through various methods. These methods include holding actual dollars in reserve, using excess crypto as collateral, or using complex algorithms to keep the peg. But price stability is definitely not guaranteed. In 2022, Terra USD crashed spectacularly from $1 to nearly zero, destroying billions in value overnight. It turned out that the stable in the Terra stablecoin was about as reliable as that friend who says they're 5 minutes away when they haven't even left home yet. Meanwhile, many governments are currently exploring central bank digital currencies, or CBDCs. These would combine the benefits of digital currency with full state backing, but they would remain centralized, unlike true cryptocurrencies. So while stablecoins offer a promising middle path, they introduce their own risks that should not be overlooked. So we come back to our original question: is cryptocurrency the future of money? As we've seen, while crypto's decentralized nature offers a radical alternative to the traditional system, significant hurdles remain, as current volatility makes it impractical for daily transactions. High fees and slow processing times during peak periods further challenges used for daily payments. Even innovative stablecoins, despite attempting to merge crypto technology with price stability, have faced reliability challenges. Therefore, in its current state, it's difficult to see cryptos like Bitcoin replacing traditional money for everyday use in the near future. The challenges are simply too great right now. However, the technology is constantly evolving, and breakthroughs like the Bitcoin Lightning Network aim to solve some of these problems. The future of money might not be what we expect. Though, if history has taught us anything, it'll probably involve people fighting over who has more of it, while financial experts make convincing arguments about why they should manage it for you. For just a small fee, of course. What do you think? Is crypto an investment, a future currency, or something else entirely? Let us know in the comments below, and if you enjoyed this video, please like and subscribe for more content. Thanks for watching.